Hello, mortgage fans. So back in the office, which is very nice, sporting some rather bad helmet hair for my lovely new Vespa. But that is the best way to get around town if you wouldn't want to get on public transport for any reason at the moment. So lovely backdrop, nice to be back. And also a number of ways we're doing this update. We've also got the video here, we've got the email that comes out, but we're also on Spotify. So please do look out for our channel there. We've got lots of these old updates and more beside as well. But diving straight into the news this week. So, main headline for us is lenders feeling the strain. Um, the figures from the Bank of England came out for up to March and breaking all sorts of records. I think net mortgage lending hit 11.8 billion in March, which is the highest level they've ever seen since records began, which surpassed the previous record, which is in October 2006. So just a phenomenal amount of lending going on at the moment. So that's one factor. The other factor is that a lot of major banks rely on India for their back office processes. Now, obviously, you just need to pick up a newspaper or read the news anyway to realize that India's not having a great time right now. So they can't rely on that resource as they have done. So if you put record levels of lending with reduced capacity, some lenders are really feeling the pinch on that one. Now, however, that's not the case for all banks. Quite a lot of banks run pretty much everything from the UK, and God willing, the situation in this country with COVID very much seems to be on retreat. So those lenders are relatively unaffected. So you put all this together, and we're coming around to now the new stamp duty deadline at the end of June. This means lender choice is going to be really key, because if you need to move to another lender that's maybe fractionally more expensive, but they can get a mortgage offer out in time to hit that deadline, and it saves you up to £15,000 in stamp duty, that's a bit of a no-brainer. So that's going to be a big theme really now for the next sort of 4 to 6 weeks as we come up to that stamp duty deadline. So we're going to probably spend a bit more time looking at by lender, and we share some data on that. It's probably not a major factor now because all banks will get an offer out in time, but certainly as you go through May and into June, it's going to be a really big factor. The other big thing in our world is the Bank of England and base rate movements, or not as the moment. So Bank of England held interest rates at 0.1% on Thursday. That was widely expected, so nothing new there. What is interesting though is inflation is on the rise. It went up to 0.7% in March from 0.4% in February. CPI, which is the Consumer Price Index, which is the index that the Bank of England look at for inflation, is now widely predicted to go above 2% before the end of the year. Now that's very relevant because the Bank of England's sole job arguably is to, well, there's two jobs really. One is to keep inflation at 2%, that's their target level, and the other is to promote financial stability. So what happens in normal times is if inflation goes above 2%, you would expect the Bank of England to raise interest rates to curb spending. That's what happens in normal times. But we are very nowhere near normal times. So it's unlikely the Bank of England will increase interest rates anytime soon, because even if it does go above the 2% level, they're not really minded to curb spending because we're a consumer economy. And if people aren't spending money, then the whole economy is in trouble, really. So unless anything goes really crazy with either GDP or inflation, I would expect rates to stay flat, certainly for the remainder of this year. The only little caveat I would put in that it wouldn't be out the realms of possibility for the Bank of England to reverse the emergency cut they made as COVID set. So instead of being at 0.1, we might go back to 0.25, because the argument would be, well, that's not really an increase, that's just a reversal of the emergency cut. So I wouldn't be surprised to see that at the back end of this year if the wider economy is performing very well. So if you translate that into what's happening with interest rates, so money market's all pretty flat last week. The stats are on the website and they're on the email if you want to get them. So everything's pretty sort of flat, which is expected because we were coming into the base rate meeting and that expected to be flat as well. So no real surprises there. So how that translates then into best rates available. The best rate on the market at the moment is 0.99%. That's a 2-year variable rate. The best fixed rates start at 1.03% for a 2-year, and the best 5-year money is at 1.21%. And then buy-to-let rates starting at 1.19% as well. The interest rate that you'll be offered is widely variant on mainly your situation, which is determined by your level of income, your level of deposit, and what you're looking to do. So the spectrum you're sort of running to is the figures I've just mentioned, up to sort of 95% mortgages, which are very much back in the market as well. But you're looking to pay around about sort of 4% on a 95% mortgage. So anywhere between literally 1% to 4% is what you'll pay dependent on the level of deposit you have. So that's really it for this week. If you want to see more of this, please do go onto our Spotify channel, our YouTube channel, and hope to hear from you guys soon.